name is Wayne McDonald. I'm the Chief FX Market Strategist for TradersWay.com. If you trade Forex, metals, energies, indices, or binaries, it's the place to be. Hey, today's Monday, January 12th, 2015. Yeah, it's Monday. So we got to plan out our week. We're going to do the Commitment of Traders report. We're going to review the weekly calendar for risk events. Then we're going to go over the major pairs, anything with USD on it. And then we're going to go through the yen pairs, anything with the JPY on the right. So let's get this party started. Huh? So it's 7:30 in the morning in New York, which means it's lunchtime in London. Hey, did your screen update, or do you still see the giant business card thing? No, I'm not getting a preview properly. You see charts, Ron? I guess my preview is just delayed. Okay, awesome. All right, so yeah, let's go with the Commitment of Traders report. We still have this Kiwi yen up here. I just want to point out before we flip over that we're at the monthly central pivot point. You see that? And guess where the short is? Off of the weekly central. Be careful. Be careful on that one. Could get interesting. Okay, so let's start with what? Commitment of Traders report? Now let's do the calendar. All right, first thing as far as the calendar, let's plan out our week. It's going to start out, it's a fairly quiet week. These are just the high volatility events. British CPI. Yeah, that's always interesting. I mean, obviously, anything with inflation is important. We thought Bank of England was going to raise interest rates. A year ago, we figured they'd be doing it about now, and our expectations have changed a lot. So CPI is always important, but it's not as important as it could be, because it would be most important if we figured they were about to raise interest rates. But I don't think we're there. So a good number on the UK CPI would only sort of put those cards kind of slowly back on the table. But I think what we're going to need is 2 or 3 good CPIs before we get interested. So let's go for a good number. If it's a good number, it might be scalpable. You might be able to get in it long British pound for a little while, but the trend is down. All right. When you look at the I have 18 screens with over 100 charts. So every once in a while, I'm going to talk about a chart that you don't see in the webinar here. It's just because I'm leaning over and looking at the thing. So for example, I'm looking at pound dollar daily, and it's down. So one decent CPI number is not going to make a bullish trend out of that, but you might be short-term long for a while, and then maybe use a binary to hedge it if you do want to be in it for longer than a scalp or a spot. Okay, moving on, we got U.S. retail sales. Well, it's important. We want to see that chugging along. And retail sales often correlate with the housing market as well as durable goods. That'd be ideal, right? You get a stabilized real estate market. So what that means is people are reinvesting into something long term. It also means that there's credit available, right? And that market's working. But then you buy a house, you get a deal on a house, but it needs fixing up, right? So you start going to Home Depot and buying new toilets and sinks and countertops and hiring construction crews to redo the roof and all that kind of stuff. So all of a sudden there's work out there, there's sales. You got to buy a fridge, so that goes in durable good orders, and it all kind of links together. And we might be seeing some of that just because the U.S. economy is doing a lot better than other developed nations, right? So retail sales, a good number is obviously important. I think in this case, we just don't want to see a bad number. Okay, because I don't think an amazing number there is going to change central banking policy. So we just don't want to see a bad number there, right? But it should be able to, if it's much better than expected, or it's a miss, then you might get a scalp out of it, right? Then Aussie jobs report. You know, Aussie jobs report is one of my favorite scalping events, right? Aussie NFP. Very good opportunity to trade. Also, I'd like to trade, different sessions. So this is a nice one because it's in my evening and stuff, and I have a lot of stories how, even when I'm traveling, there have been times where, like when I used to stay at the Waldorf in New York all the time, and so I remember one story where I'm down in the Bull and Bear. It's a famous bar where JP Morgan used to hang out, right? So there's, ghosts of Wall Street walking through this place. And I remember one time I'm having a steak and a nice glass of wine at the bar, and then I said, "Oh, I got to pay my bill. I got to go up to the hotel room. I'm going to trade the Aussie jobs report. It's going to be awesome." This is a few years ago, obviously. I go up there, boom, make the trade, pay for the whole day, and head back down to the bar and have another drink, paid for the hotel room, paid for the dinner, paid for everything. Thank you, Aussie jobs report. So I got a special love in my heart for the Aussie jobs report. It moves the market. You get your spike, you get your trade, and then you can wrap up shop and move on calm. Okay. Moving on here, PPI. This is actually very interesting. I almost pay a little more attention to PPI these days because not just in the US, but in all economies, because, like Eurozone's another great example. They're so worried about deflation, right? They don't even want to say the word deflation. But you're not going to see inflation on the CPI if you're worried about deflation, because CPI is after all the other inflation's kicked in. It's sort of like the last thing to get inflation. PPI is on the producer side. So if you build widgets and gadgets and sell it to consumers, CPI is when consumers have to pay you or the retailer more money for those widgets and gadgets. PPI is for you as the producer. When you're buying the material that is required to build a widget or to build a gadget, it's when those prices go up. So you see those prices go up before you see CPI prices. Well, right now PPI is way down, right? Because what? Wheat is down, right? If you're making things out of wheat. Speaking about JP Morgan, I think it was JP Morgan that lowered their price forecast for iron ore and coal for next year by 40%. Well, what? 40% expected decline in prices? So obviously, if the prices of these raw materials are falling, PPI is going to drop with it, because that's what it's measuring, inflation. In this case, we might want to see deflation. Well, deflation is not good. You don't want to see prices skyrocketing, but you don't want to see them tanking either, right? So, we want to watch PPI and say, okay, well, if commodity prices are low but then stable, then that's decent for around the world, because now they can, let's say, have affordable energy, and they can buy resources to make things and pass that on, and I don't know, it's it can be good, right? Lower prices are not necessarily bad. Deflation is bad. So I want to see some stabilization in the PPI. Okay. Now, if PPI goes up, that shows the economy is doing really well here in the United States, and that the Fed should probably lean toward normalizing of interest rates sooner than later, and that could move the market. Okay? We're not seeing that these days, but that's what we're looking for. If it was PPI in the Eurozone, what we want to see is a stabilization in the fall of inflation. Okay? But if it keeps falling, that's going to force Dougie to do quantitative easing. By the way, before I move on, let's talk about that briefly. So we know early last week, Draghi at the European Central Bank asked for more powers with a wink, wink, nudge, nudge, hint of wanting to do the quantitative easing. But the thing is, he didn't mandate. He didn't have the power. He didn't have the authority to do it. So he asked lawmakers, okay? Then later in the week, which was more like Thursday now, the staff at the European Central Bank drew up a plan to do, I don't know, what was it, 500 billion euro quantitative easing plan, but split between the ECB and the individual sovereign central banks kicking in money too, and then they start purchasing bonds with that. Okay, but it's just a plan on paper, but you know, and released or leaked to the public kind of thing. Now, this week, I believe it's this week or maybe next week, the courts are going to come together and decide whether they should give Draghi and the ECB the authority and the mandate and the power to do the quantitative easing. So it's all, they're lining up the ducks, right? What should that mean for the euro? Weakness. That's it. I mean, just down, 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 down. Right? Just, and if you don't understand, let's just talk about that for 2 seconds. Supply and demand curve. When supply increases, the value of that product decreases. When I was a venture capitalist, I had a rule of thumb. Every time you doubled production of a project, let's say you're making widgets, every time you double production of widgets, your cost, because of the economy of scale, drops by 30%. Okay? Every time you double production, your cost per unit drops by 30%. Okay? Because you have more and more and more and more and more of this product. Its value gets less and less and less. Okay? So if you're putting more euro into the market, there's just euros everywhere. You're flooding the market with euro. Euro, 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 euro everywhere. Its value decreases. Okay? So that's what we're looking for out of the European Central Bank. And that's specifically why it's dropped from 140 to, 118. Amazing, right? G'day, Joseph. How are you? How's your mum? Awesome. Okay, so PPI, and this is US PPI. I wouldn't worry about it too much, but use the knowledge of PPI for other economies. I would say UK and Euro are most interesting, or even Aussie, right? See, Aussie. Remember we talked about JP Morgan cutting their forecast for 2015 for the price of iron ore and coal. They knocked both of those down by 40%. Well, guess who sells a lot of iron ore and coal in the open market? Australia. Crikey! Yeah. So that's not good for Australia. Maybe that's why Governor Stephen at the Reserve Bank of Australia says the Aussie dollar is only worth 75. Hey, we're at 82 and falling. Now we're back down to 81.50. But good news to use, right? When you see Aussie dollar on its way up to 83 and Governor Stephen says it's 75, it should be worth 75, not 83. I mean, look, what is that, 700-800 pips, right? And then you're thinking, well, their major exports are likely to be worth almost half of what they're worth now. I mean, maybe sell some of that Aussie, right? Get rid of that alpha dog. So anyways, PPI, man, PPI. That's where you're going to see it. So watch Aussie PPI. Okay? Weekly unemployment claims in the United States. Again, as long as it's not a bad number, it should be possibly scalpable, but nothing more than that. I don't think it's going to change central bank policy in the United States. Philly Fed, another good opportunity to scalp. Usually about, I'm going from, gut feeling here, but it's usually worth about 25 to 30 pips on a scalp. But again, we have a nice trend established, and that's nice and stable. Good. CPI, again, very important in the United States, worth a scalp. A good number is good for a scalp. A bad number is bad for a scalp. Okay, but I don't think it'll be a game changer unless it's really, really good or really, really bad, and that would be unexpected, right? And then consumer sentiment, why not, right? It could be a market mover. I don't care that much. So let's move on to the commitment of traders report. Oh, hey, let's go back to the calendar for a second. So how about pound and Aussie to begin the week, and then lots and lots and lots and lots of dollar this week? Okay, you got it? Pound dollar, Aussie dollar, and then anything dollar. That's how you plan out your week. Okay, pound and Aussie should move pretty good in the beginning of the week. All right, so commitment of traders report. Okay, people go through the commitment and the COT data on a regular basis. Say yes if you do that. And then if you have no clue what the commitment of traders report is, let me know. Okay, Jim said yes, like, or been like new. Let's say it's new to you, okay? Type in new if you're new to the commitment of traders report. That way I know like what kind of detail I need to go into. Okay, lots of new. Okay, good. Let me ask you something. Would you like to know? And again, this isn't opinion. This is fact. Large positions held by hedge funds for the currencies. These positions are so large that the government requires that they're reported just so they know how stable or unstable the market is. I mean, think about that. Do you think that's important? Would you like to know that? Yeah, I mean, it's not opinion, it's fact, right? Now, it's not a perfect study, and I'll tell you why. Okay, one, it's futures, not cash. Okay, but we're looking at non-hedged positions. Okay, so it's futures, it's not the open spot market. And the data is a little old. This is of Tuesday of last week, and the numbers are reported essentially at the market close on Friday. So this information was available to you on Friday. You couldn't have traded it because the market was already closed. So, it's not terribly old, but as of Tuesday of last week, at Tuesday's close, these are the large reportable positions from non-hedgers. Okay, so it's not perfect, but it's something. It's something to look at. Will it put you into a trade this week? No, but it's part of your fundamental analysis. And I like to do this every Monday just to, screw my head on straight. It's sort of like, checking the radar. Okay? Market sentiment, if you will. Okay? So we have several lines here. What we're looking at is the black line, which is the net. You take all the long positions, all the short positions, and you'll see a couple of things, right? You'll see change from one week to another, and you'll also see the zero line in the middle of the chart. The zero line means if there's more people short than long, the market will be net short and the line will be below zero, indicating negative, okay? If the black line is above the zero line, that means you add up everybody long, everybody short, and there's more bulls. So you would be above here, okay? The red line, that's the euro priced in dollars. So that's the value of the euro USD. So you can see about a week ago, it was below 120, but just about it, right? 1975. Okay, so that's about Tuesday. And then the orange line here, as you can see, are people short. The gray line are people long. Okay, so you got the long, the bulls, the bears, the net, and the price. And this is for the euro USD as of last week. Okay, let me get my drawing tool. I think it might be helpful here. 1 second, please. Boop, 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 boop. I guess while we're waiting for my drawing tool, why don't you type in the currency pairs that you would like me to cover today once we're done with the COT data? Tell me what's on your mind. Let me know how I can help. Thank you, Ron. Thank you, Sue. Thank you, Jim. Thank you, Izzy. Okay, so what we're looking for here is a couple of things. Okay, this is Euro USD. We're looking at the net, and you see week over week. More people are short. Well, the market's more short. So let's take a look. Some people went long, long positions, but many more people went short. End result, the market is bearish. Okay, bearish we know because below the waterline here. Okay, this is the waterline, the zero line. So we know it's bearish, and week over week, the market has become slightly, but reasonably more bearish. Okay, so being long would be very aggressive because not many other people are. Okay, so you mark that down, or just in your mind, right? Maybe fundamentally your bias, part of your bias is the study of large non-hedged positions by speculative trading firms like a hedge fund. Okay, the market is short and more short week over week. Let's take a look at the Great British Pound. Okay, week over week, we went from bearish, okay, from this level to much more bearish to that level. There's a slight increase of people going long and a dramatic increase of people going short. Okay, notice that we're still fairly close to the waterline, right? Remember, in contrast, how many people were short euro? So the market here is short the British pound, but it's not like dramatically short, but the change in short positions increased significantly. Okay, so again, what I'm looking at is this is where we were last week. This is where we were this week. Okay, you see the week before, almost no change. So that's why I say the increase was dramatic. But then again, we're not very far from the water line. So, the market is definitely short. And there's room for it to fall if we want it to. All right, so you look at this and say, should you be buying dips or selling rallies? And that's your decision-making process, not mine. Okay? Let's take a look at Japanese yen. Right? How many times last week did we talk about buying and hedging at like 119 and 118? A lot, right? All right, week over week, slight change in long positions and almost no change in short positions. The net, it shows that everybody's short and just slightly on Tuesday of last week, less people short. But does it show you, though, when we went from 120 down to 118, does this help at all? Well, what it's showing you is there was very little change. Some change, but not a dramatic change. So it tells me, the way I read it, of course I could be wrong here, the way I read it is that the market sentiment is still bearish on the Japanese yen. Even though we've had, we dropped 400 pips off the top, that fundamentally, or at least the market sentiment, how they get to this conclusion, it doesn't tell you. But it does tell you that their sentiment hasn't changed dramatically. 7 years, Joseph, I've been doing Forex a lot more than 7 years. But thank you. Okay, let's move on.com. Swissy. Ooh la la. Now there is something interesting. Look at these moves, man, in the Swiss franc. Check it out. Look, there's dramatically less people long and dramatically more people short in just the last 2 weeks. Okay? Now, one of the major reasons for this is there has been, I don't know if I haven't confirmed it, but there's at least rumors that the Swiss National Bank is going to lower their threshold, lower the floor from 120 to 115 if Greece is kicked out of the Eurozone. Wow, look at the, oh, Kiwi broke right through it. Wow. Kiwi's getting clobbered. I'm watching Kiwi dollar and Kiwi yen falling dramatically. Not much happening on USD yen. Euro USD is falling. Pound dollar's falling. Beautiful trade setups. Let me take a break on some on the COT data just because there's so many nice things going on. Let me move over to the pig because our calendar showed us that we should be trading the British pound early in the week versus later in the week, right? Okay. Let me clean up my charts a little bit here. Let me get off. Let me put that there. Let me get rid of this one. Okay. A couple of things going on here for the short. One, we have the pullback, lower high, lower low. A technician would be bearish, right? Then what do? You set up the retracement and sell at resistance. So we got the retracement, fine. Where's resistance? Well, the first thing I like to do is highlight the psychological levels. Okay. The daily central is in here as well. And then what's the other thing I like to look for? The sweet spot is somewhere between the 382 and 618 Fibonacci retracement. Okay. Slightly higher than this, you got price action reversal off of a 618. So to me, when you look at the daily, it's basically 382. The midpoint psych level is basically 50%. And just above that, the price action roll reversal is basically 108. So I don't know which one of these is going to hold, but one of them is going to be interesting. I know that. If I'm a bear, I want to sell high, and I want to sell high at resistance, and I got a confluence of fibs and a bunch of other things, right? Central pivot points, midpoint psych levels, price action roll reversals. Then the next thing I like to look for is overbought conditions. And the more overbought, the better. In this case, it's we're going to, you typically use an oscillator. And the more overbought, the better, because it shouldn't be overbought in a downtrend. You can be oversold all you want in a downtrend because everybody's selling it. Of course it's oversold. By definition, it should be oversold. But it shouldn't be overbought. In that case, the market might be wrong. And you can see all it was a bounce at a psych level. That's 51.00. If you're a bull, that's your shot, obviously. Okay, but now, if you're a bear, this is where you should be bearish. Okay, so it comes up, hits the psych level, hits the 50%. Could be an interesting opportunity here. If you've missed it, maybe you'll get lucky and it'll give you a second chance. And a second chance would be like maybe a 5-minute cycle. And, you know, it does one of these things. Okay. If you're a bull and you're still bullish off of 51, okay, then here's what you're going to do. You measure the low, you measure the high, and now you're assuming a higher low. I would look at things like typically roll reversal stuff. I don't see a lot in here. I look at psych levels. Obviously, only the double bottom would be a psych level. So one thing you would look for would be a Fibonacci retracement. That's all you really have. And I'm eyeballing it here, but this is probably a 382, 618 is probably about here. Okay. And a bull, let me change the color now. A bull would be thinking, you know, probably something like this. In which, if that happened and I was a bear, I'd sell it up here too. I didn't notice I couldn't see it before. Not only is it a roll reversal based on price action, 786, which is a reversal area for Fibonacci, that's also the weekly central pivot point. Okay? To me, I'd rather be bearish than bullish. You know, selling off the midpoint level, jamming a stop, taking a walk. It's probably the plan for me. That's your alpha, not mine. Very quickly, zoom over to the euro. Actually, no, forget the euro. It was moving, but not as much as like Kiwi. Yeah, Aussie was Oscar Mike as well. Roger that. Thank you, Overlord. All right. Well, you know what? We got some support in here. And I'll be gone tonight. All right. You want to trade it like this? How would you mark it up? I'm going to move this down a little bit. And I grab this in here. So what this means is I think it has farther to go before I look to trade. It looks like it's way down. But to me, I like to buy at support or sell at resistance. I don't think we're at any of it. I don't think we're at amazing support, and I don't think we're at amazing resistance, right? So, I mean, if you're going to short-term trade, you know, you could look at something like, let's see, you know, something like this. Probably hesitate in here. That just gets you back to, what is it, 77.60, 77.50? I've seen better anyways. But that's what I'd look for if I was a short-term trader. So like if you're trading on the open or something like that, or front-running the equities, you know, fine. Take a high cycle on the 5-minute chart up into a roll reversal. Now, it'd be a small trade. You know, it'd be a 5-minute chart, and you might be in it for, you know, 20 minutes. All right. But Sometimes that's what it's like. Of course, another opportunity would be to let it retrace back into resistance and then just drop a binary on it and just say, I think it'll be lower, right? Because that's all you have to do. You don't have to say how low or all that kind of stuff. You just have to say, let's say in an hour, we're going to be lower than this area. Why? Because all this resistance and it's been falling and blah, 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 blah. So just wait for it to be open on a 5-minute chart at resistance near the equity open, throw down a binary, and you're gone. Take a walk. That'd be another opportunity, right? So at least you're selling at resistance in a falling market, and you're removing volatility. All right. So let's head back here. Let's move on. Let's take a look at that Alpha Dog. Aussie dollar. Market is net short. And week over week, in fact, over the last 3 weeks, dramatically more short. But, okay, no change in bears. No change in bearish positions. No change in bearish positions. Only less people long. Could be a change in sentiment. Some people were buying it off 80, remember? I guess they just totally ignore central banking policy. They just completely ignore the fact that the Reserve Bank of Australia has told us it's worth 75. So they were longing it, right? And finally they've given up. So again, no change in bearish positions, right? But some of the bulls have given up, finally. Remember, the market can stay irrational longer than you can stay liquid. Somebody's learning that the hard way. Or you notice that happened during a period when the Japanese yen got stirred. One thing I do track is Japanese bond fund flows. Oh yeah, I know. And it's interesting where that could be Japanese foreign bond investments being sold off. Basically, Japanese banks and other large institutional investors, like pension funds, divesting out of some of their Aussie positions for now. Right? That's all. There's less people long, but not more people short. I find that interesting. So now you look at that and you go, why? Well, pull up the Japanese bond fund flow data. You have to, by the way, you have to, if you want that data, it's released on a weekly basis by the finance minister of Japan. So you got to Google that. I think it's Minister of Finance.jp, and then you get to the website, and it's all in Japanese. So you got to kind of figure out where you click, the English. Then you get that, and then you can download the spreadsheet, and then you get this big spreadsheet full of data, which is very confusing. But I can get that data for you and tell you. It's just nice to know, I think, especially when you're trading the Japanese yen. I mean, I love trading the Japanese yen. So it's very interesting to see, because just like the Commitment of Traders report that I have open here, which is reported to the US government, the Japanese government, in particular the Minister of Finance, requires these large transactions to be reported to the government of Japan. And so you can see banks and pension funds and all that kind of stuff. they're constantly buying and selling bonds. Some of them are JGBs, Japanese government bonds. They're buying and selling them in the open market. And I don't really care about that because you can buy and sell as many JGBs to another Japanese investor, and it's not going to change the value of the Japanese yen because the money doesn't cross a border. But they also constantly buy and sell foreign bonds. So they buy a bunch of Japanese bonds, right? So now let's say a Japanese investor buys a bunch of Australian bonds. What happens? They get the bond, so they own the asset. They're going to earn interest on their investment. That's why they did it, because there's no inflation and no interest, no yield on Japanese government bonds. So if you're an institutional investor, you want to earn more money on your safe storage of money than the level of inflation in Japan. What is the intent? Okay, the intent of the Bank of Japan and the intent of the government of Japan is to create inflation. What level of inflation are they trying to achieve? You guys let me know quickly. What level of inflation is the Bank of Japan and the government of Japan trying to create? Come on, guys, quick. We don't have all the time in the world. We got to go. Igor says 2%. Thank you, Igor. I don't know where everybody else is. 2%. So you're a huge pension fund or some other institutional investor. You're risk averse. You want to make a long-term but safe investment. Something ideally guaranteed by another government, by another central bank, right? If you leave it in Japanese government bonds and you're earning, let's say, 0.5%, but the government and the Bank of Japan are intent in creating 2%, then guess what? They're probably going to be successful because they're changing government laws and central banking policies to create all of this and stimulate the economy and do whatever they can. So they're probably going to be successful at some level, 2% or close to 2%. Which means as a long-term, risk-averse institutional investor in real terms, even though you're guaranteed to get 0.5% in yield, in income on your Japanese government bond, in real terms, because inflation's close to 2%, you are guaranteed to lose money in real terms. So what do you think an institutional investor is going to do that's risk averse? Keep it in Japanese government bonds and be guaranteed to lose purchasing power? To have their long-term investments being eaten away by inflation? You think that's what they want to do? No. So what are they going to do? They want to buy a low-risk, guaranteed investment that pays them more or at least the 2% level. They're not trying to make money, they're just trying to not lose money. So, guess what? You buy an Australian Japanese government bond. Now you've got your inflation taken care of. The Australian government guarantees their bond, so you got a risk-free investment that covers your inflation risk. Nice, right? So I like to track this because now you're this Japanese pension fund. You buy an Australian 5-year bond. You're going to be guaranteed enough to cover your inflation level. But what do you give the Reserve Bank of Australia? What do you give them? Or whoever owns the bond, right? You're not actually buying it from the government. You're buying it from someone that owns that bond. But what do you give them? If you get the bond and you get the guaranteed income, what do you give them in exchange for this? You're buying it from them. So you got to give them some Australian dollars because there's a bank somewhere in Australia that's holding that 5-year note. Sells it to some bank in Japan. He says, yeah, well, it's going to cost you, 10 million Aussie dollars. Well, the bank in Japan doesn't have Aussie dollars. They have Japanese yen. So what do? They go to the foreign exchange market, exchange their yen for Aussie dollar, which means they're selling yen to buy Aussie dollar. Beautiful. That's how Forex works on an everyday basis. Supply of yen goes up. Supply of Aussie dollar goes down. The value of the Aussie dollar goes up. The value of the Aussie dollar or the Japanese yen goes down. All because of this bond purchase. All because of interest rates. All because of inflation levels. All because of central banking policy and government policy in Japan. That's how we trade. And all this data is reported. Here's the futures market data reported by the Commodities Futures Trading Commission, the CFTC, in the US of A, and the Minister of Finance in Japan. You can track all of this. I love it. I love it, all on a weekly basis. Use it like a radar. Hey, anything for you, Ron? I don't know. I've been doing this for a million years, guys, and I still find all that information fascinating. I love to follow the money. Okay, Canadian dollar. This is the last one for COT today. Slightly bearish market, slightly more bearish market. Not a big, okay. A few more traders, a few less traders long, a few more traders short. But as of Tuesday of last week, not a dramatic change. Which I think is amazing because oil prices are so low and have been tanking. You can see, here's this is the USD CAD going up. Remember, Canadian dollar losing value, right? So USD CAD's been going up in price, but not a dramatic change in positions. Okay? And let's go through the ends and let's call it a day. This is, Mondays are always long, right? So let's go. Let's start with the news trade, with the new setup. I think we'll just end it on this scenario. We'll just go through these really quickly. Okay, let's take a look at this. Here's gold. Let me clean up my charts. Oops. I think we probably, won an hour. Okay, so there we are. I had this as resistance last week. Guess what? This could be support. Are you a bull on gold? If you are, then here's what you're trading. Breakout, retracement, what used to be resistance is now support. If you're a bull, you should be ready for that. Because again, this used to be resistance. Oops. Come on now. This used to be resistance. Now it should be support if you're a bull. Got a nice little kicker here. It's probably not going to make a full cycle down because it's trending up. All right. You're probably wanting to know what the target is. Well, here's the weekly central. This is the target for the week. Conservative target, 1244. Aggressive target, 1251. Let's just call it 1250. Okay, about a $25 upside. If we get there today or tomorrow, then I would say up to $1,250 and then down to 1,200. Up 25, down 50, if that happens in the next 48 hours. What? Okay, let's take a look at oil. This is WTI. Yeah, crazy trade plan, eh? Yeah, double top at the 3A2. Drop it like it's hot. It's even making lower highs and lower lows. I think we talked about this last week. Wasn't the target like 41, 42? Well, 44 to 42. Sorry, 44 to 42. We talked about that at $50 a barrel, at $49.50. Now we're at 46 and some change. It's a start, right? It's a start. It's only a couple of bucks, but it's trending, right? So again, down, up. The 382 predicts a 1618 Fibonacci retracement. 44 is only a 1382. Okay, the 1618 is down there. So again, this high to this low to the 382 predicts to the 1618, which is actually 42.5. Okay, it's not my opinion. It's just Fibonacci theory. Next, S&P 500. Let's take a look on an hourly. Looks like a lower high to me, right? If you're a bear, you take the high, you take the low, you take the lower high, should come down to a lower low. Okay, we're zoomed in a little too much, so let's back out, get some more data. And this would be the bull scenario. You got to take the low, the high, then a bull would think higher. Okay. The weekly central pivot point is in here at 2035. Back out a little more. I think let's get rid of this giant fib. Yeah, the 786 is the old one. I remember that because it predicted probably a failure to rally to the top. But anyways, let's go back into here. So now you would cluster fibs and pivots. And yeah, see, we're off the 382s. So what it feels like to me is one of these days where we come down to maybe the weekly or the 618, and we try one of these things. So we double top, lower high, so probably lower low, but then the prevailing trend should kick in, and we retest the channel, and then break to the upside. And by channel, what I mean is visually the way I draw this is a channel like this and a channel like this. Okay, so once the bullish trend resumes, or if the bullish trend resumes, just like anything else, you would break, right? You'd break the channel, probably test this high, come back, test the channel, and then make a new higher high. Okay? Fractally, this is interesting because all you're doing is this. So that's a 1 hour chart. On a 4 hour chart, all you're doing is this. That's it. Okay? Simple fractal geometry. All right, let's move on.com. I'm not going to do the footsie. Forget about it. We don't have time. Pound yen. Let's clean up the chart. What do you want to do on pound? Doesn't look very bullish. Okay. If you want to try to be long pound, you have the opportunity. It does look like a bottom. If that holds, weekly M2 predicts weekly M4, which puts us back up here at 185. Currently, we're at 79. Okay, double bottom on the M2 predicts an upside to an M4. Your risk is if you get to about, what is this, 83, then you got this going on. Okay, so anyway, so here's how you do this. Drop into a smaller time frame, try to long it. Your first target's 85, your area of concern is going to be off of the 83 area. Or if you're a bear, 83 is going to be an irresistible place for you to short. Okay. something like this, maybe a little fatter. Okay. Let me zoom in here on like a 15-minute chart. What you'd be waiting for is the next cycle. Okay, you see how you had a lower high, lower low, lower high, lower low, lower high, double bottom, higher low. Now you're way up here, so you should be looking for a higher low, higher high if you're a bull. Probably near the end of this Stochs cycle, probably only drop about 70%, not quite oversold. Other areas that you'd use on a 15-minute chart, you'd use the level, you'd use previous level support, and you'd look at a fib, and you'd look at the EMAs, and it seems to me you got a lot going on bullishly around 180. If you're a bull on this. Okay? And that's not far from where we are now. What do you stink? Smell like a plan? If you're a bear, you need to sell it off the high. Okay, midpoint psych level. I mean, it was there for you. Right? Midpoint psych. Overbought. Drop it like it's hot. Or even do one of these. Okay, if you're a bear. Got it? Let's move on. Euro USD. I think we did this one, right? Yeah, I think we did too. We didn't do USD yen. All right. USD yen, look at this gray area is a trade zone that we've already drawn in the past. Guess what? Important here. Okay. We just bottomed out and made a higher high. So if you're a bull, which you could be, because the bears have already traded it, right? Bull, then you got to remark this. Okay, so I would say if I was a bull, areas of confluence, there's not a lot going on for bulls. Maybe the midpoint psych level at 1850. If you're a bull, you're going to look at this area. Let me draw it here. This here is going to be an area of interest, so I'd say about a 50% retracement. And then maybe an opportunity down here. Oops, to along. Okay, and if you're a bear, I mean, you already had your gray zone. I mean, we did it on Friday. So if you're a bear, you probably already shorted. Right? Why? Because, you know, come on, MT4. Come on now. Because you're looking at it basically like that. Okay. I'd rather this go up or down. So if I had opportunities to buy, I'd probably hedge it with the binary option. Right? Just like we talked about last week, how do you get into a bullish technical trade plan? How do you get into a bullish fundamental trade when the market is still technically bearish? Well, you hedge your position, lower your risk. Right? That's how you use binaries. And then how are we doing with USD CAD? Okay, it made a higher high, came down. What's the sweet spot? Somewhere between the 382 and the 618 Fibonacci retracement. You go long. Slowest trade in the world, it seems. Finally did it, right? And then what? Small breakout, small retracement, gone. Just like we talked about on a different currency pair. Okay, just a classic breakout pattern. Let's look at it on an hourly chart. And not surprising, is it? Notice that while this was doing this, oil was doing that. So is it crazy to be buying IPs? It's only crazy not to have a plan pre-established. mean, think about it, guys. If you said USD CAD, I'm buying dips, then buying a 50% retracement is not complicated. Okay? Simplify your life. Identify the trend. Decide ahead of time if you're a bull or a bear. And if you're a bull, you buy retracements at support. The rest is just you making it complicated. Yes, we record these every day, Justin. YouTube.com/C, as in channel, /Traders Way. You'll also find it on tradersway.com. And I'm here Monday, Tuesday, Wednesdays, and Thursdays. Same time, same place. I encourage you to ask more questions. The more this is interactive, the better it is going to be for you. Okay? Will I see you guys tomorrow? Awesome. So thank you, Justin. Thank you, Jim. Thank you, Ron. Thank you, DeBeesta, Izzy, Greg, Jimmy, Holger, Joseph, Frank, Ezra, Aaron, Andrew, etc., etc., etc. Peace on earth. May the pips be with you. May your profits be above average. And thank you to Traders Way for making all this happen for us. Cheers.